Hello and welcome to this weekly market recap for the week ending June 13th, 2025. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats.com. It's a pleasure to be with all of you again this week. Kind of an interesting week last week in that we got some really tame inflation data. 2 days last week, we had reports out. First, we had the Consumer Price Index, and it came in well below expectations. The headline number was expected to come in at 0.2% increase, came in at 0.1. And then if we strip out the more volatile food and energy area and get down to the core CPI, we're expecting a rise of 0.3%, and we came in at 0.1%. So really, really solid CPI report. The very next day, we had the PPI report come out, and we had the exact same results. Headline number came in at 0.1% rise versus the consensus 0.2% rise. And then if we strip out the volatile food and energy prices and just look at the core PPI, that came in with a 0.1% rise versus the 0.3% rise expected. So the numbers coming in on inflation, very, very solid. On the CPI news, we actually saw in pre-market action pretty good reaction to the upside, but that was as far as we got all week. Generally, for the most part, rest of the week, we saw sell-off. We did see consumer sentiment on Friday jump back up to 60. We've been seeing that in the low 50s. I've got a chart on that for you later in the show. But typically, whenever you get the sentiment, that University of Michigan consumer sentiment number down at all-time lows or near all-time lows, that normally is a sign that the market's already priced in all the bad news. And normally we see bottoms form and prices react off of that. And I think if you haven't seen that chart, I think you'll enjoy seeing that and how the relationship works between market action and the consumer sentiment. But let's go ahead and jump into the action here from last week. Take a look first at the major indices. You can see the S&P 500 did fall a little bit, down 0.4%. NASDAQ down 0.6%. Transports down 1.3, Dow 1.3, Russell 2000 1.4, and the S&P 400 mid cap almost 1.5%. So across the board, it went down. It looks like the more aggressive areas, the S&P, and especially the NASDAQ 100, outperforming, but it just didn't feel like that at the end of the week, especially, like I said, after that Wednesday CPI report came out. We saw, what I felt was a little bit of rotation back towards value and away from growth. And I don't know if that really sets up great for us here in the second half of June. We have made our way now through the first half of June, and we just know that this month, among the summer months, well, at least looking at the start of summer or late spring, going from May, June, July, up until when I consider the real go away period, which is in the middle part of July. That's historically when the worst period of the year starts. But leading up to that, we normally have a pretty strong start to May, and all the way through most of the month of May, and then into the first half of our first part of June. But from there on, it can be a little bit rough. And so I don't know if, history takes over and we just kind of meander a little bit to the side, sideways for a bit. But we do have earnings season, believe it or not, starting in about 1 month from now. And so as we get closer to the end of June, I certainly expect that the market will start to think more about earnings and what that might do to valuations. And given the fact that, we really haven't seen a whole lot of impact from the tariffs, my guess is that we're going to have another run up as we head toward earnings season. And that could generate some breakouts in some areas that I'll talk about in just a little bit that are either threatening a breakout, like right at a breakout level, maybe have just made a breakout, or are approaching breakout. And so as we get, into that pre-earnings season mode, some of these areas we may see those breakouts occur if we haven't already. Moving on, let's talk about the sectors. So energy, huge week last week. Energy was really what carried the market. You can see gaining 5.6%, big jump in crude oil prices last week. And many of the industry groups within energy also doing very well. Healthcare was second on the list, a little bit more defensive, but there's technology. Technology still came back down later in the week, but still had a decent week. But it's just surrounded by more value oriented. So you got energy, healthcare, and then utilities and real estate. So you got defensive groups, you've got more value oriented groups. And I think that's why the progress to the upside in the market slowed. We just didn't we kind of ran out of strength in those aggressive areas that tend to lead us to the upside, especially during secular bull market advances. So you can see there's the S&P 500. So we had a little bit of outperformance in discretionary, a little bit more in technology, not so much in communication services. And we saw, some defensive value-oriented groups outperform, and then others, consumer staples, underperformed. Industrials and financials, which I consider to be aggressive areas, but they're more value-oriented aggressive areas. They're more cyclical, and those two groups in particular were lagging all the other sectors last week. So again, a little bit of a mix to me. I didn't really see great under the surface action to support continuing move to the upside, and I think that's why toward the end of the week we tended to roll over a little bit. Let's look at the S&P 500. So here we got up to about, let me give you the exact number. So the S&P 500 on Wednesday got up to 6,059.40, which was only 85 points below our all-time high at 6144. So very, very close. This is one of those indices I'm talking about approaching all-time highs. And I'm sure there weren't too many folks 2 or 3 months ago thinking that we were going to be back up near these all-time highs. To be quite honest, it's come back faster than I thought it would. I thought maybe we might meander sideways a little bit more over the summer and then maybe make a bigger move in the fall. But, it's hard to count out the market, especially when you're in a secular bull market, which we have been in since the S&P 500 cleared the 1550 level back in April of 2013. NASDAQ 100. Look, we got up over 22,000, and just over 22,000 at 22,175 is our all-time high on the NASDAQ 100. We got close. We got to 22,041. That was the high back on Wednesday. So again, we weren't very far, less than 1% from making that breakout off of that severe drop that we saw with the low back on April 7th. So we pretty much have gotten back all of those losses. Pretty impressive rally that we've seen. Small caps. This one, especially with the inflation data coming in lower than expected, I really thought this was a group that was going to shoot higher. And on Wednesday, when we got that news, I believe the IWM was up to 217 and change. Might have even hit 218 in pre-market. But you can see by the end of the week, we were back down to 208 and change, testing that 20-day moving average. This is an area where I think small caps need to rebound. If we don't and we go below the 20-day moving average, I think it's going to look more like sideways consolidation. But coming off of a pretty bullish bottoming head and shoulder pattern right here, normally coming back down to test that area, and it was actually a rising neckline. So coming back down to test should have held about 210, 211. Now, sometimes I've talked about this more in recent years. I've seen breakouts, and then we go back down below the breakout level, and that used to be a stop for me. And I talk more about the 20-day moving average now. And you can see the IWM falling back down, sitting almost right on that 20-day moving average. So if we do fall at the beginning part of this week in small caps, I'm not saying that that's the end of the bull market. I'm far from it. I believe we're going a lot higher later this year. But it does start to negate this pattern, the reverse head and shoulder pattern, which measured up to 250. If you can't hold on to support after you make the breakout, that generally is not a good sign. And I would not rely as much on the measurement. So the early part of this week, I think, will be big in terms of that measurement. Now, if we fail and the measurement goes away, again, that doesn't mean I'm bearish, but I would certainly start to pay more attention to the 50-day moving average, which is now at 199, the recent low, which is around 200. And then there was gap support from back on May the 9th at probably around 201. But if we don't hold 208 in this area, I think that 199 to 201 level comes back into play. And so as I've been telling members, I've been in the IWM, but I've been moving some of it to leverage. And especially as it pulled back and got to that 20-day moving average, I thought that was a great opportunity. But again, we need to open up on Monday, or at least have a nice solid reversing day on Monday in order for me to continue thinking that that leveraged product is a good idea. The reason I like to wait and get that leverage product when it comes down to a key support area like the 20-day moving average is that I can exit it pretty quickly without a whole lot of damage. So what I normally do, if I'm in the QQQ, I might move out, if I get more aggressive, I might move out into something like the TQQQ, which is a 3 times leveraged ETF. And likewise with the IWM, the TNA is a 3 times leveraged. Now, I would suggest if you are not a aggressive investor, that you stick with the basic ETFs. I would not take on leverage. I would suggest only those who have a really high risk tolerance, maybe younger, maybe you've got your retirement already set, and this is just what you're considering play money. Then you can maybe get a little bit more aggressive. But I just want to make sure that folks that should not be getting into these leveraged products, you really shouldn't get in if your risk tolerance doesn't dictate that. All right, let's see, another one, transports coming down. We actually saw the transports hold the trend line, this recent trend line, but did close below its 20-day moving average for the first time since back at the beginning of May. So it had been about 5 or 6 weeks since we had closed below the 20 days. So that was just worth noting. Again, when you go up, you can see neckline, head, right side of the neckline, right shoulder. And it looked like, this is a little bit of an upslope, looked like we were approaching the breakout, didn't quite make it. But I would like to see this 20-day moving average for the most part kind of hold, see a reversing candle on Monday, similar to the IWM, and then move back up to highs. Short of that, if we fall further Monday, close down on Monday, this is going to look more like sideways consolidation from maybe 14,000 up to about 14,005. All right, let's talk a little bit about the sectors. First, technology. You can see technology on Thursday. It actually, even though the market started to roll back over again, starting on Wednesday, technology actually on Thursday went up and tested, maybe cleared barely the all-time high close. So the all-time high close, I see 241.76 there. And I believe that is it, 241, yeah, 241.76. On Thursday, we closed at 242.57. So Thursday marked an all-time high close on technology shares. Even though the S&P hasn't broken out, even though NASDAQ hasn't broken out, we did get a higher close on technology, which I think is a good thing because that's your leader. If we go down here and look at the bottom, this is the relative strength. Let me get rid of the crosshairs there. But this is the relative strength line. So we saw technology leading everything to the downside. But now on a relative basis, we just moved on Thursday to the highest level we have seen since we were declining back at the end of July of 2024. So technology is really looking good. And it's hard to bet against the market when technology is performing as well as it is. We could see a pullback. Certainly technology, especially after that failed breakout, we could see a pullback to the 20-day moving average. But I'd keep an eye on this one because as long as this group either goes along for the ride with the S&P 500 or outperforms, I think that the selling will be short-lived in the market. If we start to see more selling and more accelerated weakness in terms of relative weakness in technology, then we may have a different story. Might see a little bit deeper selling. So that would be one of the clues that I'd be looking for in the upcoming week. XLY, let's pull up XLY, take a look, see what's going on here. More just a bull flag. So we got the flagpole going up and then just sideways action. So I find this to be bullish, but we do want to hold on to the recent lows, which down around 207. So I'd kind of watch that area on the XLY. You can see on a relative basis, we were moving up for a couple of months, kind of broke that, just kind of maybe moving a little bit more sideways right now. If you're bullish, you want to see this relative ratio turn back to the upside. If it continues weakening, and especially if it were to go back down below that March low, relative low, that would be a bearish development in the market for sure. XLC, communication services, just like technology, right up against that high, this time from the high in mid-February. We've pulled back. Looks like maybe 20-day test coming up. But again, let's see how that plays out. Many of these charts are showing this negative divergence. So you can see the higher prices from mid-May to just a week or just a few days ago. Definitely higher prices. Look at the PPO coming down and starting to roll over again. So it's not even like right now it's building to the upside. That would argue a little bit more selling, potentially losing 20-day moving averages, maybe going down, hitting price support, and possibly even the 50-day moving average. So if we do see weakness early in the week and we see technology and some of these aggressive areas leading it, I think we could see some of that selling accelerate. So just an FYI. All right. For those of you that are new to EarningsBeats, if you go over to our homepage at EarningsBeats.com, you'll see we have a free 30-day trial to our paid service. You do need to provide a credit card for that. Just want to make you aware. But before your 30-day trial is over, we will make sure that we reach out to you to let you know that your 30-day free trial is expiring, and what the cost is going to be for the monthly membership, and then also normally provide you a much better deal on an annual basis, normally about half the cost of what you would get on a monthly basis. So anyway, check that out. We got a lot of, we're coming in to the end of the second quarter, getting ready to start the third quarter, heading into the next earnings season. This would be a great 30-day period to kind of see how we do and how the market does. So think about checking that out. And if you just want to, learn more about what we do have a free newsletter that does not require a credit card. That's our EarningsBeats Digest, which comes out a couple times a week, Mondays and Wednesdays. Name and email address is all you need to provide there. So make sure you check that out. Let's just keep on moving here. So one thing I wanted to point out, last week, this is our flagship chart list over at Stock Charts, our strong earnings chart list. I was a former practicing CPA. So for me, it's really important that company management teams, fulfill their promises. And that's essentially what this strong earnings chart list shows us. These are companies that in their last quarterly report beat Wall Street consensus estimates as to both revenues and earnings per share. So their top line and their bottom line both came in ahead of expectations. And that's important because where does Wall Street get these expectations from? Management teams. They go out, they talk to them, they see what their last quarter was, they look at projections, and then they come up with their own consensus estimate based on what they see in the economy and everything else. So when companies are able to beat it, that's really, in my opinion, it's like confirmation that you've got a really good management team, that's running the company and your investment. So anyhow, strong earnings chart list is kind of our flagship, and we've got probably 400 companies on here, annotated charts. But I wanted to just point out here, last week, the top 5, one was Oracle, which came out with great numbers. And as a result, stock was up, I think 2 days in a row, pretty significantly. It was up, there you go, 7.69% on Friday, but it also had a big day on Thursday. That was the reaction to its earnings report. But these other 4 stocks, they are all on run, Solar Edge, SPRY, and then Groupon. These 4 are all on our short squeeze chart list. So I found that interesting because when stocks start to break out, if they're on the short squeeze chart list and they're starting to see their volume accelerate, it's an indication that a lot of folks that are short selling the company are being forced to cover. And you really want to make sure the volume is picking up to get to kind of confirm that story. But anyway, I wanted to show you, here is a short squeeze chart list that we offer to our members. Right now, there's like 70 companies on there. And what we look to do with that short squeeze chart list is to point out the companies that have more than 20% of their float short. So of the shares that are free to trade out there, 20% of them, at least 20%, have those shares have been borrowed and then sold by short sellers, meaning that they have to cover and they have to buy the stock back and then return those borrowed shares. So it's forced buying. So when you start seeing a breakout and you see the volume pick up, think about the folks that are on the short side that are either going to have unlimited losses as prices keep going up, or to end the pain, they add to the buying by covering their short and then returning those shares back to wherever they were borrowed from, which normally is like a Schwab or Fidelity or whatever. But anyway, I wanted to point out some of these stocks, just go over a few of them before we wrap up the show. I got one other chart I'm going to show you on that sentiment I promised earlier as well. But let's take a look first at Solar Edge. And the way this is set up, by the way, all of these charts have a percentage next to them, and they're in order of that percentage. And that percentage is the percentage of float that is short. So it's just giving you an idea. The ones that, the first stocks in this list are going to be the ones that are most heavily shorted. Doesn't mean you just go out and buy them. I think that there are times when you buy these stocks, try to get your money quickly and then get back out. That's the way I try to play a short squeeze stock. I don't buy them and hold them forever because many of these stocks will just keep going down, down, down. Anyway, let's take a look at Solar Edge. So here's Solar Edge Technologies, SEDG. Do you see the volume pick up? Now this particular chart list, I have my chart set up a little differently. I have the volume at the top with the average. I've got a 50-day average volume in here with that blue line going across. Kind of zero in here and give you a little bit better look. And then here's the actual volume. So you can see on Friday, Solar Edge made a pretty good breakout, taking out prior highs, and did so with expanding volume. That could have been somewhat fueled by short sellers that were trying to end the pain, because if you look at this stock, it closed over $23 a share, and you can go all the way back probably to the end of September. That was the last time we saw Solar Edge climb back up above 23. These renewable energy stocks have been absolutely crushed. A lot of folks betting against them with shorts. When these stocks get running, they can run very, very fast. So I just wanted to point out Solar Edge, one of those stocks making a big run, and 32.3% of its float is short. 32.71% of runs float is short. Now here we don't have a breakout going back many months, but we certainly have come well off those earlier lows. And if the stock could get up and break out above 13 and that volume stays high, you could really see a lot of folks stampeding one another trying to get out of their short positions. So keep an eye on run. Another one, SPRY. This was a third one that I talked about. And here you can see the AD line on this one really strengthening, which I like to see because that's giving us a sign that maybe the stock's being accumulated. We have a lot of tops coming across here between about 15 and 15 and a half. And we closed at 15.39 on Friday. So very strong. You can see the volume ticked up, but not even to average volume. It's going to be interesting to see if we continue that move on Monday. And if so, watch the volume to see if that starts to pick up, because if it does, you could see another huge move in a stock like SPRY. Now, again, this stock is a little bit like leveraged products. I would not be looking at these, heavily shorted stocks and be trading them on the long side unless you have a high risk tolerance. They are very volatile. Sometimes they look like there's a breakout. It looks like a short squeeze, and the carpet just gets pulled out from under. You can quickly lose 20 or 30% or more on these stocks. So you do have to kind of, be watching these throughout the day. If I wasn't able to watch the market, I would not be even thinking about trading these. Again, they're very aggressive. Another one I wanted to show you was, Groupon been moving up for a while, but I'll show you that one real quick. So here's Groupon. I mean, shorts have just been pummeled on this stock here. Stock was at under $10 in March. Now it's $33.89, almost $34. Let me give you a couple of others, though, that kind of are interesting right now. Lemonade, big move up, clearing all of these highs. Look at that volume, up above the average, way above the average. OCGN is one that I had put in our EB Digest, our free newsletter, on the day that we broke above 80 cents. So we went up to $1, came back down, tested 80, and then we broke out again and got to $1.20. I mean, 80 to $1.20 is 50% in what, 3 or 4 weeks? So, again, stuff we provide sometimes in that EB Digest, it's not all just educational. There are trading candidates if you're so inclined. This obviously was a very aggressive one. You can see the volume, though. Both these moves did pick up quite a bit over the 50-day moving average. One that really exploded with massive volume was PHAT. Look at this volume, 50 million. Now, this is a pharmaceutical. I don't know what happened. Maybe it was data that came out, positive data, clinical trial. I don't know. But if you're shorting a stock like that and you get news and volume like this, I mean, this was a stock that was trading in the 4s. The next day it was in the 12s. So watching these and seeing the volume come in and seeing a breakout, you can sometimes expect that it'll be followed up with more buying, more folks looking to exit their short positions. Another one, this one's been on fire, SMR, New Scale Power Corp. Not only just breaking out above recent highs, but this is breaking out, I believe, to all-time highs. But let me see what, no, that's not the right chart I want. Yeah. So this company went public end of 2020, and right now it's at an all-time high. So it's breaking out into uncharted territory with a pretty large short position out there. Now it's one of the, let me see, it's down toward the bottom, I believe. Yeah, so it's a little bit over 20%, 20.48% of its float. But still, when you get a breakout with volume, you've got folks that are holding the stock, number one. You've got folks that are buying the breakout, technical breakout, number two. And then anybody who's been betting against this company thinking that, hey, this is just smoke and mirrors and the stock's going to come back down, they've got real decisions to make, because this is a stock that a month ago was trading at 17.5. And at the end of last week, it was up over 42. So if you're sitting there shorting, remember, you've got unlimited risk. However high it goes is how high you have to buy it. What if this thing catches more fire and goes to 50, 60, 80, 100? And you're sitting there and you have sold it for maybe $15 or $17, and now you got to buy it back at 80 or 100? That gets really expensive and really scary, which is why they call it a short squeeze, because the shorts get squeezed out of their positions. But that's some massive volume that's been trading, and we've got big breakouts. So this is a stock definitely that's been doing some good things for those who have been playing short squeezes. All right, last thing I have for you today, I just wanted to show you the sentiment chart. So here's the S&P 500 for the last 50 years. The consumer sentiment report that was out on Friday came in at 60. Prior to that, and I think the estimate for this current reading was supposed to be around 53. And I think the prior reading was 52. And you can see the all-time low going back 50 years is 50. But I want you to pay attention to these lows and what happens to the market after you get down near 50. Right here was the low. It marked the low in April. Back in 2022, it basically marked the low in the cyclical bear market of 2022. Here in 2011, it coincided with one of the financial crisis aftershocks that we saw back in the middle of 2011, reached the low right when we were printing that low on sentiment. The financial crisis. Now, to be fair, the low in the 50s came in much earlier in 2008 than the actual bottom, which we saw in 2009. But for the most part, the sentiment remained very, very low and did ultimately mark this bottom. You come over here. This is 1980. This was at the end of the big, long secular bear market we had in the 1970s. And so sentiment got down to a point where we marked a major low. You come down here in 1990. This was the Persian Gulf War. What happened after we marked a low? We never saw that bottom again. So just remember, sentiment is a contrarian indicator. When everyone feels horrible about things, buy the stock market. And we were just there. And no big surprise, the last huge secular bear market was 2000 to 2012. Guess where sentiment was at the beginning of that secular bear market? At the highest level ever. Everybody felt wonderful about things. That was your sign to get the heck out of the market. So remember, these sentiment indicators give us signals, but they're contrarian signals. So they're contrarian indicators. So in other words, when the sentiment looks great, you should be worried. When the sentiment is horrible, everybody's panicking. That's when you should be holding your nose and buying the market. Anyhow, that's all I got for today. I really appreciate you tuning in. I'll be back next weekend for your next weekly market recap. Have a great week ahead, and let's see how we start the market off the beginning of the week, because that may have some rather significant impact as to how we trade the rest of the week. Anyway, have a great weekend, everybody. Happy trading.